Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
I'd like to retire, jokingly when I'm 25, but I think it'd be nice if I could retire by the time I'm 60. That'd be a more reasonable goal, I think.
I am hoping for 55. I don't know if it's realistic, though.
55, maybe.
By 60 at least.
Probably around 60.
58.
Well, I'd want to retire at 32.
There's a bunch of people who aren't thinking about retirement.
Welcome to the only show in the country dedicated to helping savers worry less about money, the Worry-Free Retirement, with your host, nationally recognized retirement specialist and six-time author and fiduciary, Tony Walker.
In 2002, shortly after I began working on the creation of the only process in the country dedicated to helping savers worry less about money, something I trademarked and use every day called the Worry-Free Retirement, I began thinking about all the young people and even baby boomers such as myself who knew nothing about my granddad and his generation of retirees and how they made staying home from work look so easy. Armed with the motivation to prove why retirement for young people and baby boomers would not resemble anything like that of my granddad's, in 2007, my production company proceeded to direct and create the documentary you heard at the introduction of this show called Say Goodbye to Granddad's Retirement. Now, as we fast forward to the recording of this show on August 1st, 2023, I feel as though this documentary had been a fulfillment of prophecy expressed within it. So what did this documentary and the past 16 or so years of me working in the financial trenches since its release teach me as a financial advisor on how best to help savers be worry-free in retirement just like Granddad? Well, let's find out. Well, welcome folks to the Worry-Free Retirement, and yes, I am that little man in the sweater vest retirement planning specialist and fiduciary, Tony Walker, and before we share with you how to take a glasses half full approach to bidding farewell to Granddad's retirement, let's dive in and get right to it. But first, wait a minute, I'm looking around the studio. There's Derek over there. Derek, where's Aaron?
He got summoned for jury duty, boss.
Oh, well, anyway, Derek, thanks for showing up.
Yeah, no problem. I mean, as you know, it was for my court case, but one of us had to be here, so we flipped a coin.
FBI, open up!
Oh. Whatever. So let's step back a second and look at what Granddad's retirement looked like in 1978 following his 43 years of commitment to the same phone company where he climbed telephone poles, worked in the engineering office, and then ended up on the front porch of his little house in Troy, Kentucky. And how did this generation of savers pull this thing off called retirement? Well, first, that generation of retirees had something called guaranteed lifetime income, and it came from two sources. One, the employer-provided pension plan, which those aren't around much anymore. And second, Social Security, which again, you might be saying, well, Tony, Social Security's around. Yeah, but you got to remember, in 1978, Social Security was stocked full of money. There was no concerns of it having to go down or, run out of money, which it is today, projected to be running out of money in about the year 2034. So they didn't worry about Social Security going broke. The next thing Granddad and his generation, most of them had, was paid for health insurance. That's right, 100% of those premiums were covered. So again, Granddad didn't have to worry about the expense of health insurance. And then finally, here's a biggie, folks. Listen, none of those folks back then, hardly any of those folks in 1978 had any money in the stock market. 401k had just been created, and one reason they didn't need money in the stock market is because bank CDs back then paid 10, 11, 12, even got as high as 18% in 1981. So obviously earning that kind of interest, who wants to fool the stock market, right? So with all of those items no longer on the table for today's retirees, is it any wonder that much of what I shared in this documentary, Say Goodbye to Granddad's Retirement, some 16 years ago, turned out now to be true. Which is why today I'm going to show you why relying on the stock market to create a lifetime income is dangerous playground for savers, and how we at Tony Walker Financial can help you create a worry-free retirement just like Granddad. So stay tuned as we say goodbye to Granddad's retirement and hello to Tony Walker Financial's brand new take on life called Mailbox Money. I'm Tony Walker. We'll be right back.
Have you recently retired, been laid off, or offered a pension buyout? Has the company you work for moved, been acquired, or closed its doors forever? And finally, do you have a 401k with a previous employer you'd like to move to safer territory? Then take advantage of this opportunity to move your 401k or lump sum pension to Tony Walker Financial. Let's meet in person to discuss your retirement options. Log on now to TonyWalkerFinancial.com to schedule your free, no-obligation appointment. Let us help you today.
With the uncertainty of the stock market, our nation's debt spiraling out of control, and inflation running rampant, now may be the best time to consider moving your 401k to safer territory. My name is Tony Walker, and for over 38 years I've made it my life's mission to help savers worry less about money, and I want to help you too. To speak with me at no cost or obligation, why don't you log on to TonyWalkerFinancial.com and let's get started.
Corporate companies have sometimes maybe cracked the whip too quickly and said, okay, we will reduce the workforces, we'll retire these people early, and we'll make way for a few people that we can hire at a lower wage. I think they ought to go back and reassess the value of that someday. Some economist who's smarter than all of us ought to go back and say, did they get a bargain in making that deal?
In case you're just now joining us, during the breaks, you're going to hear some snippets of the documentary I produced back in 2007 called Say Goodbye to Granddad's Retirement. Basically, it was my take on what young people and even baby boomers might be concerned about, what they need to think about in the future. And ironically, we're getting ready to talk about this article in just a second. A lot of what I was concerned about, and that is people not having guarantees in retirement, or what I like to call mailbox money, like Granddad, these people would start to worry. Before we get started, again, if you're just now joining us, America's favorite financial sidekick, Mr. Aaron Orander, has been called out on jury duty. And Derek, you're pretty busy over there preparing for the TV show. I was going to mic you up. Everything going okay over there, partner? You look pretty busy. Okay, well, hang in there. I'll check in with you later. You take it easy over there. All right, so let's get back to the subject at hand. Let me call up. I've got this article called up on my computer. You can't see this through the magic of radio, but this came out, let's see when this article did come out. July 26, 2023. Again, for our purposes, I'm recording the show on August 1st, 2023. And I love the headline. It says, "Our glass is half empty," in quotes. Then it says, "Why your clients are worried." This comes from News Retirement Magazine by Matthew Sellers. And then the subtitle says, "It's not just older workers who are concerned about their ability to save for retirement." So again, the theme of this, we kicked off the show with an excerpt from basically a documentary I produced of sorts in 2007 called Say Goodbye to Granddad's Retirement. It was my take on why retirement was going to look so different than my granddad, who got to retire with his pension and Social Security, paid for health insurance, being a Bell South retiree. He even had free long distance. And as he finished up his life down in little Troy, Kentucky, down there near Versailles, Kentucky, incidentally, drove right by his house the other day. I was cutting down Highway 33 for some reason. I think I was heading from Versailles to Nicholasville. You all that live in that area there on our Lexington station know what I'm talking about. But yeah, it's kind of surreal to drive by and look down there and see the driveway. But anyway, that was a period of time where people didn't worry about the stock market. They didn't worry about running out of money because they had what we like to call mailbox money. So now, as we fast forward, this is what the documentary predicted. people would not have mailbox money. They would not have guarantees. They've been relying way too much on Wall Street to create this worry-free retirement. And as this article says, people are starting to get very worried. Now, let's talk about this study that BlackRock, which is a huge global money manager, estimated to have over $9 trillion in assets under management. You know, I thought our $200 million under management was a lot of money. That is crazy. But anyway, BlackRock did a study, and it revealed a concerning trend among participants in U.S. retirement plans. That would be maybe you. Maybe you're putting money in a 401k plan. And here's what it basically summarized. And this is just over the last 2 years. This is, you know, we covered the other day the disastrous results of the government lockdown as associated with the pandemic. Oh, surely, hopefully, folks, politicians, whoever listening to this, please don't ever do that again. That was a disaster. But this is the rippling effect of that shutting down and the closing down of the economy and it's almost like trying to stop the Titanic and start it back up again. It's just not that easy. So it says, look at this. Over the past 2 years, there's been a significant increase in pessimism regarding their ability, that's savers, to save for retirement. It goes on to say economic anxiety is on the rise due to the factors like high inflation and, yep, you guessed it, volatile markets. Let me keep reading because this is really interesting. According to the report, the number of U.S. retirement savers who feel they are off track, they wouldn't be off track if they had a game plan with Tony Walker Financial. We monitor that for them. Look at this. The number that feel they are off track has more than doubled since 2021. Conversely, those who feel on track have dropped by 13 percentage points from their peak in 2021, making the lowest level since the survey's inception 8 years ago. So what this article and this survey is basically saying is all of these savers out there who are at or near retirement, they're watching this inflation play out. They're watching the volatility of the stock market. 2022 was the first year that really bonds and stocks at the same time went down. As somebody that's been in this business almost 40 years, I've been selling securities since 1986, licensed to sell them. That was really weird, folks. And as somebody who also manages money at Tony Walker Financial, that one caught us off guard because usually stocks and bonds are kind of work usually a little bit of opposite of each other. When one's up, the other's down and vice versa. In 2022, the reason many of you continued to lose money, even when you thought you were going to safer territory, you maybe told your advisor or you went into your 401k and you moved from an equity or stock position to a bond position and it still went down. Many of you are still down by after doing that. You're saying, well, what happened? I thought I went to a safer territory. This is the problem, folks. Wall Street, up until recently, does not offer what can provide that guaranteed lifetime income, and that's an annuity. And as much as Wall Street wants to berate annuities or the financial entertainers on radio or TV, or even a lot of these people, these so-called financial prophets and predictors on the internet, annuities, listen, are the only contractually guaranteed investment that can make sure you don't run out of money. So this is why you're starting to see a lot of these big companies, Charles Schwab, Fidelity, Merrill Lynch, all these big brokerage houses, excuse me, that, you know, they used to offer annuities on the side. They never really pushed them much, but now are realizing they have to offer annuities because this is what's happening. So many people are demanding that some or a portion, or sometimes even quite a bit of it with our clients, they want that guaranteed. They don't want to run out of money. So how did we do this? How did we pull this off at Tony Walker Financial? Seeing this coming, well, one thing, back in 2002, after I decided to get away from the stock market for a while, that's what I began to focus in. One of the first advisors in the country that pretty much focused strictly on what we call fixed annuities. And boy, you're talking about being raked over the coals. Boy, for about 5 years, I had many of our friendly competitors. I got this by way of mouth, word of mouth from people that I met with, but just said, hey, that Walker guy's crazy, man. He's over there selling all these annuities and fixed indexed annuities and fixed interest annuities, mainly fixed indexed annuities at the time. And we were putting, which we still do, we put something called income riders on those. But they're like, that guy's crazy. What's he doing with all these annuities? Well, now as we fast forward to 2023, again, call it financial prophecy, I don't know what you want to call it, but now all of a sudden It's what I discovered in this documentary. People would want this mailbox money, and again, annuities are the only thing that can guarantee it. By the way, I wrote a great little booklet on this. I would encourage you to get this. It talks about the pros and cons of annuities. Again, it's written by somebody that's written about as many annuities as anybody in the country. I think the last total I've sold right at $600 million of annuity premium, so over 3,000 annuities. I think I've kind of learned this stuff a little bit, folks, but I wrote a booklet you might want to check out. It's free. It's called Annuities Made Easy. You can order that online if you like and download it. You go to TonyWalkerFinancial.com, TonyWalkerFinancial.com. You'll go to the download section. There's all kinds of freebies on there for you, but you can download Annuities Made Easy. Now, the second thing you can do, if you say, well, I don't want to get on the internet and download anything, can you just mail me a copy? Absolutely. To do that, what you want to do is just call the toll-free number, 877-499-9255, and just let them know that you want to order a copy of Annuities Made Easy. Make sure you have your name and address. We'll mail that to you. Even if you call after hours, the answering service, just tell them, I want to order Annuities Made Easy. Mail it to me. Here's my name and mailing address. We'll get you a free copy, and we promise we won't hound you or call you after we send you one of those. All right, so what we're going to do, we're going to take a quick break, because when I come back, I'm going to go into a little more detail. Let me go to my cheat notes here. A little more detail on what happens when people are relying so much on the stock market when they come into Tony Walker Financial after we've set up these written game plans, these proprietary software. And in many cases, when we're making assumptions for the future, folks, remember, we're working with savers. We don't want to overestimate these rates of return. But the reaction of people who will say, well, Tony, I thought we could make 8 to 10% on our money. Isn't that been the average rate of return of the stock market? And while on the one hand, that's accurate, but on the other hand, it is inaccurate when you get into retirement planning. Good stuff coming your way. I'm Tony Walker. You're listening to the Worry-Free Retirement. We'll be right back.
No, I'm not saving for retirement right now. I'm just saving to pay my rent this month. But after I get a real job, then, yeah, I'll start saving for retirement.
Not yet, but I guess I will once I get a serious job.
Not really. I barely save for next week.
I'm kind of living paycheck to paycheck because I'm in school.
Right now I'm saving for my kids' college, so I'm just kind of putting myself on the back burner.
Since I'm in college, I'm just building up nothing but debt right now.
Are you retired or retiring soon? Do you have a 401k, IRA, 403b, thrift savings account, or lump sum pension that you'd like to move to safer territory? Did you know that all the money you see on your 401k statement isn't really yours? Depending on your overall taxable income, the government has essentially a lien on your 401k that can tax as much as 40% of your money when you go to take it out. Tony Walker calls this the 401k tax tumor. For almost 40 years, retirement specialist Tony Walker has helped thousands of savers worry less about money by creating game plans to deal with your tax tumor. Get control of your retirement by controlling the taxes owed on it. Schedule a free meeting to see if you can reduce your tax tumor and provide a guaranteed income you can never outlive. To get started, simply log on to TonyWalkerFinancial.com. That's TonyWalkerFinancial.com.
Whether you're a longtime viewer of the Worry-Free Retirement or just catching it for the first time, know this: you can watch past episodes and educational clips by visiting our YouTube channel. Just log on to YouTube.com and search Tony Walker Financial.
I began thinking about my retirement at an early age. I'd say probably around 21 or 22.
I started thinking about my retirement about the time I first started teaching in college, which would have been when I was about 26.
Welcome back to the Worry-Free Retirement. Tony Walker going it alone here. This is really shocking. America's favorite financial sidekick is doing his jury duty thing. And we do have Derek Hudson in the office. He's actually in the studio trying to prepare for the TV show, which we're going to do right after this. Incidentally, if you want to watch the TV show, we're on, I think, 7 different stations now throughout Kentucky to view all of the TV show times and the different radio stations and times we're on throughout the state of Kentucky and southern Indiana. Just go to TonyWalkerFinancial.com. You'll see a download section. You click on it at the far right, and it'll show you all the TV times and all that. So, also, you can go back and watch the TV show on YouTube. Just go to YouTube.com and type in Tony Walker Financial. All of our past episodes are there. So, Derek, you still look pretty busy over there. Can you do me one more favor, partner? Because I don't have the graphic in front of me. I've got to have this graphic covered. If you would, fight your way over to the monitor if you can. Tell me when you're ready. Let's start with our Tony in the Trenches, because this will set the stage. It comes from Rick in Louisville, who I recently presented one of our written game plans to. He was a prospective client, and here was his question. Tony, why are you using a 3% assumed rate of return on your Charles Schwab portion of this plan when the stock market has averaged around 10%? Now, he is correct. If we go back, according to Shiller's data, that's what a lot of people use, the S&P, that's the S&P 500, since 1971, when you include all the dividends, has averaged just a tad over 10%. So, and even people on the radio and in the internet, and even still a lot of stockbrokers, they'll just say, well, yeah, you should make about 10%, kind of flippantly. Now, if we go back in time, and let's just take this at its face value. Let's say if you had invested in the S&P 30 years ago, or 1971, however far that is back, and didn't do anything, you didn't take any withdrawals, that is correct. You would have made, obviously, exactly 10.5% with dividends. But that's not how the real world works, and that's not how retirement works. Because in retirement planning, remember, folks, this is a retirement planning show. This is not a show for investors. This is a show for savers who want a comfortable retirement, don't want to run out of money, and they want a predictable income in the future. So even though the market's done that well, but through the magic of radio, we've got this graph pulled out. Let me just give you some examples of how much the stock market has gone down. And I'm going somewhere with this because you have to understand, if you're retired and these shenanigans are happening and the market's dropping like a rock and you need money, you could easily run out of money. That's what we covered in the last segment with this BlackRock study and the fear of so many Americans now being very pessimistic, very glasses half empty attitude, because they're worried about pulling money out during a downturn and running out of money. I mean, intuitively, they know that that could happen. This is why we always try to include some annuities in there, and that's why they're demanding these products that would offer some guarantees like Granddad had. Okay, so use an example. This is pretty wild. We'll go back to the Great Depression. I don't know if we're going to have another depression, but folks, that lasted from October of 1929 through July of 1932, 679 days. I mean, that's what, a couple of years, it dropped a total of 86%. So if you had $1,000, you're left with 860 off of 1,000. What is that? You're left with $140. That's how much you would have lost. And you'd say, well, that's kind of an anomaly, wasn't it? Oh, was it? Well, let's go to December 68 through May of 1970. It was down consecutively 373 days. You would have lost 35%. This is getting ugly. April 1981 through August 1982 would have gone down over a 328-day period, 24%. Lest we forget, and I always bring this up, January through October of 2002, January 2000, October 2002, it was down 685 days during that period of time, down 37%. And then finally, the big kahuna of them all, October 2007 through March of 2009. I remember this seems like yesterday actually, down 355 days, 53%. This was probably, I remember this very well, 2007. This was probably the first time in history that all these baby boomers who were getting ready to retire or just retired really learned a lesson, because many people didn't know what to do. They were getting ready to retire. Some people had to go back to work. I mean, you lose half of your savings that quickly, again, at or near retirement, and that's some heavy-duty stuff to pill to swallow. So, with all that said, let's kind of use an example here. Let's now fast forward to somebody, and let's go back to 2008. Let's imagine, okay, you've got to live in the real world. Forget this 10% average rate of return on the stock market. It's a no deal when you get in retirement planning and start withdrawing money. So forget the 10%. This is why conservatively we only assume 3% even on our stock portfolio moving forward. We want to be very conservative in our assumptions in retirement planning. I've done this a long time, folks. It's better to be real conservative and be right than be overly optimistic and be wrong, believe me. Okay, so let's say someone started in 2005 with $300,000 and they needed $20,000 a year for the rest of their life. In 2005, they took out the 20 from the 300, but the market was up about 5% that year, so the account only went down to $293. Not bad. Okay. Age 61. Now they're a year older. They're retired. That's the year 2006. The market goes up almost 16%. They take out their 20. They're back above 300. In fact, their original 300, even after taking out $40,000, is up to 316. So this is working wonderfully. No problems. Take the money out. Your average is right up there at 10 like they predicted. The next year, 2007, makes a little over 5. You take out 20. Hey, voila. You're still over $300,000. All is well in Mudville. What's the big deal? Tony, quit worrying so much about the stock market. All right. Pause for effect. 2008. You start off with $313,000. All is well. You take out your 20 and it drops. We'll give it the benefit of the doubt. That year it dropped 37%. So you think, well, yeah, that doesn't sound good. What am I left with? Remember now, in this example, you're only 4 years into retirement. Your 401k that originally started just 4 years ago at $300,000, now that you've taken out $20,000 per year, and we've gone back to 2008, and we had another 37% loss. Almost went down that much in 2020. It went down a bunch. But anyway, you're now left, drum roll please, with $184,000. Not what I would call worry-free, and boy, would Granddad have been upset over that. So folks, that's the point. When you are working with a retirement planning specialist, you'll know you've got a retirement planning specialist. First of all, yeah, they need to be a fiduciary. That's a given. But more importantly, you need someone with experience that's been around long enough to know what can happen. I've been doing this almost 40 years. I've seen all these cycles play out before. And I know what I'm talking about when it comes to retirement planning for savers. That's all we focus on is savers, those who are more concerned about the return of their money than on it. And if that sounds like you, if you're feeling like, gosh, I need somebody in my corner who understands how I feel, my worries, my concerns, let us see if we can help. We made this real easy. We call it the free 10-minute fiduciary phone call, where you and I will talk by phone for a few minutes. And if it looks like I can be of help, we are going to meet in person. That's right, the owner of the company, in person to see how we can help you be worry-free. We can do this. You just log on to TonyWalkerFinancial.com, TonyWalkerFinancial.com, click on that Let's Get Started button, and we'll arrange a meeting at either our Bowling Green, Louisville, or Lexington, Kentucky offices. Or if you'd like, just give us a call anytime at 877-499-9255. That's 877-499-WALK. Well, we've enjoyed being with you today, but you remember, between now and next week, if all else fails, you be worry-free and make it a good one. I saw a cup in there that says, follow your dreams. How do you feel about that statement?
Depends what your dreams are.
Do you have any dreams?
Not anymore.
It's kind of like a story that I heard about a road up in Vermont that was unpaved, and there was a sign on the side of the road that said, "Choose your ruts carefully, you'll be in them for the next 20 miles." What you decide today is going to influence what happens tomorrow.
You may live 20, 30, 40 years. What are you going to do with it? And that's the hard part for people in their 20s to think about. That's hard for people in their 40s to think about.